Imagine a world where financial freedom isn't just a dream, but a reality within your reach. Picture yourself breaking free from the chains of debt and embracing a life of abundance. What if the secrets to building wealth fast were hidden in plain sight? Every day, countless people struggle to make ends meet, but there's a way out. What if one of the greatest investors of all time had the keys to unlock your financial potential? Warren Buffett, a name synonymous with success, offers insights that could change everything. Before we begin, write in the comments, "I am fully aligned with my path to prosperity." As the clock ticks, the opportunity for wealth slips away. Are you ready to seize it? The journey to financial independence doesn't have to be a lonely road. Imagine joining a community of like-minded individuals, all eager to learn and grow. But hold on, what's the first step? How do you turn your dreams into reality? The answers might be simpler than you think. Stay tuned as we dive into powerful strategies that could transform your financial future. This isn't just about money. It's about creating a life you love. Keep your eyes peeled, because the next moment could spark a change you never thought possible. Principles of Warren Buffett's investment. Warren Buffett is often regarded as one of the greatest investors of all time. His investment philosophy revolves around the idea of long-term gains rather than quick profits. Buffett believes that investing is not just about buying stocks. It's about buying a piece of a business. He emphasizes the importance of understanding what you are investing in, which is why he often says, "Never invest in a business you cannot understand." This principle encourages investors to focus on companies they know and can analyze thoroughly. Buffett also stresses the significance of fundamental analysis. This means looking at a company's financial health, management quality, and market position. He advocates for evaluating a company's earnings, debts, and cash flow before making any investment decisions. This kind of analysis helps investors determine whether a stock is undervalued or overvalued, guiding them toward making informed choices. For Buffett, the numbers tell a story, and understanding that story is crucial for successful investing. Another key aspect of Buffett's philosophy is holding investments for the long haul. He famously refers to his favorite holding period as forever. This long-term approach allows investors to ride out market fluctuations and benefit from compounding growth over time. Instead of chasing short-term trends, Buffett encourages investors to focus on the intrinsic value of a company and to be patient while that value manifests. Investors who follow Buffett's principles often find themselves developing a different mindset about the stock market. They begin to see it as a place to build wealth through disciplined strategies rather than a casino for gambling on trends. This shift in perspective can lead to more thoughtful investment choices and ultimately better financial outcomes. Adopting a long-term view can also help investors remain calm during market downturns, reducing the likelihood of panic selling. Lastly, Buffett often advises to invest in what you know. This doesn't mean putting all your money into tech stocks just because they seem exciting. Instead, it means looking for companies within industries you understand well. By concentrating on familiar sectors, investors can make more informed decisions and recognize potential pitfalls. This principle is about leveraging knowledge to gain a competitive edge in the investment landscape. Importance of fundamental analysis. Fundamental analysis is at the core of Buffett's investment strategy. It's a systematic approach to evaluating a company's financial position and understanding its potential for growth. This method involves digging deep into a company's financial statements, including income statements, balance sheets, and cash flow statements. By analyzing these documents, investors can assess a company's profitability, liquidity, and overall stability. Understanding key financial ratios is crucial for conducting effective fundamental analysis. Ratios such as price to earnings, PE, return on equity, ROE, and debt to equity, D/E, provide insights into how a company is performing compared to its peers. For example, a low PE ratio might indicate that a stock is undervalued, while a high ROE shows that the company is efficiently generating profits from its equity. These metrics help investors make sense of a company's market position and future prospects. In addition to quantitative analysis, qualitative factors should also be considered. This includes the company's management team, competitive advantages, and market conditions. A strong management team with a proven track record can significantly impact a company's success. Likewise, understanding the competitive landscape helps investors recognize how well a company can perform in its industry. Moreover, fundamental analysis allows investors to identify trends over time. By looking at historical performance, one can spot patterns that may indicate future growth or decline. This kind of analysis goes beyond just looking at current earnings. It involves evaluating a company's trajectory in the context of economic cycles and industry developments. Finally, the insights gained from fundamental analysis can empower investors to make well-informed decisions. Instead of relying on market speculation or trends, they can base their choices on solid data and reasoned judgment. This informed approach aligns perfectly with Buffett's philosophy of investing in companies with strong fundamentals and holding them for the long term. Conclusion: in summary, Warren Buffett's investment principles emphasize the importance of long-term thinking and fundamental analysis. By focusing on what you know and understanding a company's financial health, investors can make decisions that lead to sustainable growth and wealth accumulation. Diversification and risk management. Diversification is a key strategy in investing that helps to reduce risk. The idea is simple. By spreading investments across various assets, sectors, or geographies, an investor can minimize the impact of a poor-performing investment. For example, if someone only invests in one company and that company faces a downturn, the investor's entire portfolio can suffer significantly. However, if they invest in multiple companies from different industries, the losses in one area can be offset by gains in another. This approach is often likened to not putting all your eggs in one basket. There are several strategies to diversify a portfolio effectively. One common method is to invest in different asset classes such as stocks, bonds, real estate, and commodities. Each of these asset types has its own risk and return profile, and their performance may not correlate with each other. Additionally, within the stock market, investors can diversify by choosing companies from various sectors like technology, healthcare, consumer goods, and energy. This way, they can take advantage of growth opportunities while managing potential losses. Risk assessment is another crucial aspect of investing. It involves evaluating the potential risks associated with an investment and understanding how those risks affect overall portfolio performance. Investors should consider factors such as market volatility, economic conditions, and the financial health of the companies they are interested in. By identifying these risks early on, investors can make more informed decisions about where to allocate their funds and how much to invest in each asset. Mitigating risks often requires proactive measures. This could include setting stop-loss orders, which automatically sell a stock when it reaches a certain price, or regularly reviewing and rebalancing the portfolio to ensure it aligns with the investor's risk tolerance. Investors should also stay informed about market trends and be ready to adjust their strategies as conditions change. This adaptability is key to navigating the often unpredictable nature of investing. Lastly, patience and discipline play vital roles in risk management. Investing is not a get-rich-quick scheme. It often requires a long-term perspective. Keeping emotions in check and adhering to a well-thought-out investment strategy can prevent impulsive decisions that may lead to significant losses. By cultivating patience and maintaining discipline, investors can weather market fluctuations and remain focused on their long-term goals. The role of patience and discipline in risk management. When it comes to investing, patience is more than just a virtue. It's an essential trait. The financial markets can be volatile, with prices fluctuating based on various factors, including economic indicators, market sentiment, and geopolitical events. Investors who react impulsively to market swings may end up making poor decisions that can harm their long-term financial health. By practicing patience, investors can take a step back and evaluate their choices based on research and analysis rather than emotional reactions. Discipline complements patience by helping investors stick to their strategies even when the market conditions are challenging. This means having a clear investment plan that outlines goals, risk tolerance, and asset allocation. Sticking to this plan, particularly during times of market uncertainty, can be difficult. However, disciplined investors are less likely to chase after trends or make hasty decisions based on fear or greed. Instead, they focus on their long-term objectives and trust in their research. Moreover, developing a disciplined approach involves regularly reviewing and adjusting one's portfolio. While it's important to remain committed to a strategy, it's equally essential to recognize when changes are necessary. This could involve rebalancing the portfolio to maintain the desired level of diversification or even cutting losses on underperforming investments. By incorporating this discipline into their investment routine, investors can better manage risk and optimize returns. Another critical aspect of patience and discipline is understanding that investing is a marathon, not a sprint. Successful investors often remind themselves that wealth accumulation takes time. The compounding effect of investments can lead to significant growth over the years, but it requires a steadfast commitment to the investment process. Quick gains may be tempting, but they often come with increased risk and volatility. In summary, patience and discipline are not just nice-to-have qualities. They are fundamental components of a successful investment strategy. By cultivating these traits, investors can better manage risk and work towards achieving their long-term financial goals. They can navigate the ups and downs of the market with confidence, knowing that their approach is grounded in thoughtful analysis and strategic planning. Identifying investment opportunities is crucial for any investor looking to build wealth over time. One effective technique is the search for undervalued stocks. These are shares of companies that are trading for less than their intrinsic value, often due to temporary setbacks or negative market sentiment. Investors can use various methods, such as comparing the price-to-earnings, P/E ratio of a stock to its industry peers or historical averages. By doing so, they can pinpoint stocks that may be overlooked by the broader market, providing a potential opportunity for future growth. Market analysis and understanding economic trends also play a significant role in identifying investment opportunities. By keeping an eye on macroeconomic indicators, such as inflation rates, interest rates, and employment figures, investors can gauge the health of the economy. This information helps them make informed decisions about which sectors might perform well in the near future. For instance, during economic expansions, consumer goods and technology sectors often thrive, while defensive stocks may be more appealing during downturns. Recognizing these trends can guide investors in choosing the right assets to add to their portfolios. Another essential tool for discovering investment opportunities is the use of financial reports and key indicators. Companies release quarterly and annual reports that provide insights into their performance, revenue, and future outlook. By analyzing these documents, investors can assess a company's financial health and growth potential. Key indicators such as earnings per share, EPS, return on equity, ROE, and debt-to-equity ratios can also provide valuable insights into a company's stability and profitability. Understanding these metrics helps investors make informed decisions based on data rather than speculation. Networking and engaging with investment communities can also lead to discovering new opportunities. By joining investment clubs, online forums, or attending financial seminars, investors can exchange ideas and insights with like-minded individuals. These interactions can spark new ideas and provide different perspectives on potential investments. Learning from others' experiences, whether successes or failures, can help refine one's investment strategy and open doors to opportunities that might have been previously overlooked. Lastly, staying updated on news and developments in the financial world is vital for identifying investment opportunities. Markets can change rapidly, and being informed allows investors to react swiftly. Whether it's following financial news channels, subscribing to investment newsletters, or utilizing financial apps, having access to the latest information can give investors an edge. By being proactive and informed, they can seize opportunities before they become widely recognized. Common mistakes and traps to avoid investing can be a rewarding journey, but it's not without its pitfalls. One of the most common mistakes is falling into emotional traps and making impulsive decisions. Investors often experience fear and greed, which can cloud their judgment. For instance, during market downturns, the fear of losing money might lead them to sell off stocks at a loss. Conversely, in a booming market, the excitement of quick gains can tempt them to invest without proper research. Recognizing these emotional triggers is crucial for maintaining a rational approach to investing. Another mistake is not understanding the difference between investing and speculation. While investing focuses on long-term growth based on fundamental analysis, speculation often involves betting on short-term price movements without a solid understanding of the underlying asset. This approach can lead to significant losses, especially in volatile markets. Investors should always aim to accumulate knowledge about the companies they invest in and the broader market context, rather than relying on luck or trends. The importance of continuous education cannot be overstated when it comes to successful investing. Markets are always evolving, and strategies that worked in the past may not be effective today. Investors must commit to ongoing learning, whether through reading books, attending workshops, or following market analysts. This education helps them adapt to changes in the market and refine their investment strategies over time. Staying informed about new tools, technologies, and investment theories can provide a competitive edge. Additionally, overlooking the significance of risk management can be detrimental. Many investors jump into investments without fully understanding the risks involved. They might ignore factors like market volatility, economic cycles, or company-specific issues. A comprehensive risk assessment should be part of every investment decision. By understanding potential downsides and setting appropriate stop-loss orders or diversification strategies, investors can mitigate losses and protect their portfolios. Lastly, failing to review and adjust one's investment strategy regularly can lead to stagnation. The financial landscape is dynamic, and what worked in one scenario may not work in another. Investors should periodically evaluate their portfolios, assess performance, and make necessary adjustments based on changing market conditions or personal financial goals. This proactive approach helps ensure that investments align with both market realities and individual objectives. As we wrap up this journey through the ultimate guide to fast wealth building, let's remember what we've learned today. Investing isn't just about numbers. It's about mindset, strategy, and taking action. Warren Buffett didn't become a billionaire overnight. His success came from consistent learning, patience, and a keen eye for opportunity. Now, think about your own financial goals. What steps can you take today to start your investing journey? Are there small changes you can make in your daily habits that could lead to greater wealth tomorrow? Remember, every millionaire started somewhere. They faced challenges just like you, but they didn't let setbacks define them. Instead, they used those experiences to fuel their drive. So, what's holding you back? Is it fear, doubt, or just not knowing where to start? Let this be your wake-up call. Embrace the knowledge you've gained, and don't hesitate to dive into the world of investing. There are countless resources at your fingertips, waiting for you to take action. So, what's your next move? Are you ready to invest like a pro? Share your thoughts in the comments below. And stay tuned for more strategies to elevate your financial future. Your journey to wealth starts now.